let's try to understand why we do financial modeling. Okay. Like we're trying to learn how to do it, but do we know why do we do it? Trying to evaluate a new business opportunity. Okay, let's say all of you all tomorrow come together and make a company and decide to do some sort of a business. So even though you have money and have a business plan, it might not necessarily be a profitable business unless and until you sit and put all the numbers together and try to understand whether the margins are sustainable or no. So why is this important? Let's first try to understand. Let's say we projected revenues of 10 crores in the first year, 15 crores in the second year, and so on and so forth. We keep doing the revenue projections, but when we get to the cost, we realize that okay, at the end of the whole exercise, the amount of margins that we are making are just 10%. Okay, and then you suddenly start realizing that okay, if tomorrow some bank suddenly, due to the economic situation, if starts giving a FD rate which is higher than 10%, so you realize that bare minimum any bank is paying you so much rate, and if your entire business model after doing so much mehnat, that income is going to be less than that, then it's not a good financial decision, right? So when you make a new business decision, the reason why you do financial modeling is you project all future years revenue, you project all future years expenses, and then you put time value of money to it. There's something called as discounted cash flows. This sounds like a difficult term, but it is nothing but you are just saying that the money that is going to come tomorrow, if I discount it and consider the time value of money, what is that money in today's day? What is the value of that money in today's day? So when you do that, you come to a rate called as a IRR rate. I'm not going to deep dive into it, but that rate is important to understand whether the amount of margin that you will earn after all this mehnat is enough for you to do all this in the first place, right? So one classic reason why you do financial modeling is to understand whether new business decisions make financial sense, and the way we call it, it is called financial viability. Okay. The next reason why we do financial modeling is, let's say we have a business. Okay, let's say it's a shoemaking business. Okay, and then tomorrow you decide that probably I can sell socks as well with it, right? So it's like a vertical integration. You are moving into a new product altogether, but it can sort of be added to your existing product and it is related to it. So this is a classic example of an expansion in a vertical integration manner. So here in this case also, you sort of, you say that these are your existing revenue and income and your profitability statement. And if I start doing this as well, then at the end of it, does it make financial sense? Okay. So this is the second reason. I'll repeat. First reason being when you're identifying new businesses. Second business, that it's an existing business, but you're adding some more expansion to it or some sort of vertical integration to it. The next use case is, let's say you are a company, you are a 3-year-old company who has grown beautifully and now you are raising money. So I'm sure all of you might be, reading news wherein you might be seeing that so-and-so company raised so-and-so $1 billion, or so-and-so valuation has been arrived. So essentially here what I'm trying to explain is when the money is being infused. Okay. And by this, I essentially mean private equity being infused. Okay. So when I say private equity, it typically means that, let's take an example, that you guys have a company today. Okay. And you guys fully own it. And tomorrow you want to expand further and you need more money. So basically you go to various investors and say, look, my company's valuation is 100 crores. If you give me 10 crores, I will give you 10% of my company. Okay. So in this case also financial projections or financial modeling is essential, because you say that to arrive at that business valuation, you have to project your current profit statement. You have to project how the cash flows are going to flow, and then you create a value for it, and then you decide that how much equity should I give to somebody if they give me 10 crores of rupees. Okay. So this is another use case. And last use case is when in the valuation exercise. So let's say you are a fund who has made investments in 2 different companies. Okay. Company A and company B. They're both in, let's say, wind energy. Okay. They're both generating wind, and company A and company B. So how do you compare it is that so far in through their life cycle, they were making so much of profit, and in the years to come, they will be making so much of profit. So every 6 months, right, when actual projections come in, you compare it with your budget and you say that, okay, the valuation I expected was this, but I'm only earning this much. So probably my investment decision is not giving me as much money as I first thought it was giving. Okay. So from time to map how your investments are performing is also when you do financial modeling. So these are the broad cases in which we essentially require this extensive exercise where we are projecting and trying to calculate the return. One real life PPT ka little snips to understand how the end result of it looks like, so that it's more interesting and more relevant when you all see the valuation picture, right? So here, like I said, the valuation being one of the key reasons why financial modeling is done. So let's say this is a valuation done on March 20. So you can see 231. The valuation, the way it moves is this is the end product after the whole financial modeling exercise. So what you're essentially saying is that you were here when you did the valuation 6 months back, and then because of certain things, right, the how your business has performed and how the value has depreciated, and due to various reasons, now your valuation has at September 20 reached 2024. So in this case, financial modeling helped them realize that after 6 months, the value has only depreciated. Now, this might not have been possible if the financial modeling was never done in the first place. All right. Then at today, how am I seeing future cash flows? So here, if you see, I will not get into the jargon, but broadly these are the graphs which tell you how, along with your profit, the cash flows are moving. So there can be situations where the company is actually making very good profits, but the cash flows might be stuck. They might not really be as free as the company would want to be, and these can be ascertained when financial modeling is done. Next, I would broadly touch upon sensitivity. So in terms of sensitivity, how it works is that you make the model in such a way that you try to, say that if 1% change in my assumption happens, then what will be the impact on my valuation? Okay, this might sound a little tricky. I'll try and break it down. So let's say when you are projecting something, you assumed that the business will grow year on year at 10% rate. So when I say assumption, what you are doing is with your past knowledge and experience and market data, you feel that, this will be a correct assumption to make. But try to understand that this is a probability, right? It can or cannot go wrong, right? So always in real world, there is some sensitivity analysis that is done to sort of test the business model, that if the assumptions that we have made, if 1% change in it happens or 2% change in it happens, then what impact does it do on my valuation, or what impact does it to my returns? So whenever you do any sector's financial model, right, you have to think like you are in that sector and you need to know all the nitty-gritties in that sector. See, because when you are making a model, you need to know all possible revenues and you need to ascertain all possible costs that can happen in a business model. So before I get into the deep dive of wind energy stuff, I would like to explain you all one thing called as contingencies. So a good financial model is the one which takes into account all sort of contingent expenses into the calculation, so that you are ready for all sort of uncertainties and can manage it. You are cutting it all very short, that okay, this will be the expense, I'll pay people only this many salaries. But what if somebody is performing very well? You would want to give them increment which is way better than the salary, better than the industry. Let's say that person is your key salesperson and you first thought that you would give them a 18% hike, but suddenly you realize that a competitor is trying to take away your resource. So you would want to keep the resource, right? And you would want to spend a little more on that resource. So all these possibilities, when you are making the model, you have to take into consideration, right? And this can only happen when you know about the sector in and out. So whenever in my professional journey, I would make any new sector ka financial model. I would talk to the guys from the operations team. So whenever I worked extensively on renewable energy. So I would talk to the engineers to understand what on-site problems are like, what kind of expenses happen. All of these things are very important. You have to think that now you own the company in that sector. So when you are an owner, you need to be aware about everything. So with that much amount of detail, you need to be excited and knowing anything and everything about that sector to be able to make a model of that sector. Okay.